Hey team, this is Matt from Universal CPA Review. Thanks for checking out our YouTube channel. Now before we dive into the video, please subscribe to our channel. It helps us immensely. If you're studying for the exam and looking for some Facebook study groups, the links are in the description. We'd be happy to have you. If you haven't tried the program yet, we offer a free 14-day trial. So sign up for that. The link is in the bio. And then lastly, please reach out to us if you have any questions about the program, the pricing. We can share current promotions as well as the Spilt Milk program. You're not going to want to miss that, so please reach out to us and schedule a time to chat. Now let's dive into the video. Hey team, are we ready to rumble? That's my best impression if I was a boxing match announcer. And the reason that I brought that up is because we're going to be talking about the optimal capital structure. Right? In the previous modules, we talked about debt versus equity and how to calculate the different components of a company's capital structure. But now we need to understand what is the optimal capital structure, right? It's always going to be a 1-2 punch between equity and debt. So how does a company balance the amount of debt they have versus the amount of equity they have, right? And so that is what we're going to start with. And then we're going to move into how to evaluate the performance of a company and make sure that they always have the proper ratio of debt versus equity. So are we ready to rumble? So before we dive into the details, let's make sure we understand what's on the agenda today. So I already talked about the optimal capital structure, right? And how it's a 1-2 punch between debt and equity. We're then going to run through a handful of profitability ratios, as well as margin ratios, as well as solvency ratios, and then wrap it up with debt covenants. So I apologize in advance, but this is going to focus heavily on calculating ratios. And when it comes to understanding these ratios, you simply just cannot memorize them. While it's important to remember the formula, I believe that if we truly understand why we are calculating these ratios and how to interpret them, then remembering the formula, it becomes second nature, right? So let's focus on that and keep that in mind as we cruise through those ratios today. So starting with a company's optimal capital structure. So as we talked about in the prior lectures, well, the company has their weighted average cost of capital. And I'll tell you, the number one goal for an organization or a company is to minimize their cost of capital, right? Because that allows them to maximize their stock price and their value. And investors and creditors, they want to invest in companies that have a low cost of capital because that means they can easily add value. If they have a high cost of capital, it's much harder to add value to the company. So I can tell you all day that the lowest part of the WACC is the optimal point, but let's take a look at this visual that helps us understand that, right? So when we look at the cost of equity, the cost of debt, right, the WACC is always going to be somewhere in the middle because equity is more expensive than debt, but debt is riskier, which is not accounted for in this visual. So when we look at the WACC curve, right, it goes down, but then it comes back up. We'll see that midpoint where the gold star is. That is where the WACC is at its lowest point. And that is the optimal capital structure. So if a company needs to source new capital, what they can do is go, okay, what would the WACC be if we were to issue equity? Or what would the WACC be if we were to issue new debt? And then they can see what that WACC would be compared to the current WACC and decide, okay, is this the best option, right? So that is why it's so important to understand the WACC and how different types of transactions can ultimately impact a company's capital structure. So here's a sample balance sheet that we'll use for jazz music to go ahead and go through all of these ratios, right? So we can see we start with current assets. That is things like cash, inventory, prepaid expenses, accounts receivable. And then we have non-current assets. That's things like fixed assets, property, plant, and equipment, intangible assets. And that gets us to total assets. And then we have current liabilities, which includes things like accounts payable, accrued expenses, right? Things we're going to have to pay off in less than 12 months. And then we have our non-current liabilities, which are just liabilities that we don't expect to pay for more than 12 months. And then the last piece is equity. This is mainly invested capital, right? Through common stock, preferred stock, retained earnings. So that is the full balance sheet. We need to understand the different pieces there. And then for the income statement, well, we always start with revenue, right? That is money we receive from customers from selling them product. And then we have cost of goods sold, which is the cost to produce the product or service that is sold. And that gets us to gross profit, right? So revenue minus cost of goods sold is gross profit. And then we'll subtract operating expenses, which are expenses that aren't necessarily related to producing a product or service, but they are incurred to run the business. And that gets us down to operating income. And then after that, we'll subtract non-operating items and income taxes. And that takes us down to net income, right? And net income is all of the revenue and all of the expenses combined. And that is basically our net profit. So now that we've run through the components of both the balance sheet and income statement, I do believe you'll be better prepared to fully understand these ratios. So what ratios are used to evaluate performance? Well, as you can see, we're going to focus on two different types. We're going to have profitability ratios as well as margin ratios. So starting with profitability ratios, that's going to include return on sales, return on equity, return on assets, and return on investment. So let's run through the formula and an example for each of these. So the formula for return on sales, it's not difficult. It's just operating profit divided by sales. And what this ratio tells us is how profitable and how efficient a company is at converting sales into operating profit, right? So what we want to do is increase this return on sales ratio as high as possible. Because if we earn $1 revenue, well, we want that to turn into an operating profit that's as close to $1 as possible. So obviously there will be some expenses, but the goal is to get that as high as possible. So looking at an example, it says that jazz music had an operating profit of $100 on sales or revenue of $500, right? And we can see where that comes from in our income statement. So all we need to do is take that operating profit of 100 divided into sales of 500, and that equals 0.2 or 20%. So how do we interpret this? It just basically means that for every $1 of sales or revenue, we earn 20 cents of operating profit. So the goal, right? Increase that as high as possible. Moving on to the next ratio, this is going to be return on equity. So the formula is net income divided by average shareholders' equity. And obviously net income, that comes from the income statement. That's going to cover a full period. The reason we use average shareholders' equity is because we either have the beginning balance or the ending balance. And so if we average the two, that captures basically the average throughout the year, which is where the net income is coming from. So this will indicate the overall return in which the organization's shareholders will be entitled to. So looking at our example here, it says that jazz music generated $50 of net income on average shareholders' equity of $150. And so we got the net income from the income statement, but how did we calculate average shareholders' equity? Well, it's 150, right? That's basically the average between year 5 of 125 and year 6 of 175, right? Looking at the balance sheet. So we take the average, and that is how we get to 150. So they'll either tell you average shareholders' equity, or they'll give you two periods, and you'll need to take the average. So anyway, when we divide net income of $50, right, into average shareholders' equity of 150, we get 0.333, goes on forever, right? So we'll round that up to 33.3%. And what that tells us is for every dollar of shareholders' equity in the business, well, they generate 33 cents of net income. So obviously investors, they want this ratio to be maximized. The next ratio is return on assets. And similar to return on equity, right? We take net income, but we divide by average total assets. So again, we take the average between the beginning total assets and the ending total assets balance, and that gives us the average. So what the return on assets ratio measures is the organization's overall productivity of its assets, right? It costs money to invest in assets. And so those assets, we want them to generate as much net income or profit as possible. So the higher the ratio, the more efficient a company is at using its total assets to generate net income. So looking at an example here, Jazz Music generated, again, $50 of net income and average total assets of $300. And if they weren't giving us that, well, we can see on the balance sheet, the year 5 balance was $250. The year 6 balance was $350. That averages to $300. So all we do is take that net income of $50, divide by average total assets of $300, and that equals 0.166 or 16.6%. Now, I can't tell you if this is a good ratio or not. We would have to compare it to other companies in the industry. But what I can tell you is that for every dollar that's invested into an asset, well, the company generates basically around 16 or 17 cents of net income, right? So what a company could do is they could look at this return on assets ratio from last year compared to this year and see, were we more efficient at generating income on the same level of assets, right? So that is how the ratio can be used. And then the final ratio that we need to talk about is the return on investment. That is better known as ROI. You've probably heard of it before. And basically that is net income divided by average invested capital. Right, so this one's a little bit trickier. What is exactly average invested capital? Well, it could be a number of things. They'll typically tell you, but it could be net book value, equity, right? It just depends. But let's go ahead and look at an example. So it says that Jazz Music generated $50 on net income of average invested capital of $250. So pretty simple, $50 divided by $250, that equals 0.2 or 20%. Right, so the return on investment here is 20%. So what we can say is, so every dollar of invested capital, that yields basically 20 cents of net income. So from an investor's perspective and a company's perspective, they want the ROI ratio to be as high as possible. So now we're going to move into 4 different ratios that can be used to assess a company's margins. And these are primarily based on the income statement. So we have the income statement. Let's go ahead and walk down the income statement and understand how these 4 ratios fit into the income statement. Let's start with gross profit margin because it's at the top of the income statement. So as we can see, gross profit is just revenue minus cost of goods sold. And so what we're left with, that's gross profit. Now we can take the gross profit margin to understand how much of every dollar of revenue equates to gross profit. So what we can do here, right, we see the formula, it's just gross profit divided by revenue. So in our example, it says that Jazz Music sold $500 of guitars. Since the company had $250 of cost of goods sold, that means gross profit was $250. So take that $250 of gross profit, divide by revenue of $500, and that equals 0.5 or 50%. So that tells us for every single dollar of revenue the company generates, they generate 50 cents of gross profit. So while this could be a high gross margin for certain industries, it could be lower for others. But what's important is being understand how to compare this ratio to last year, to the current year, to forecasted amounts, right? Gross profit margin, that is one of the key things that investors will look at because that helps them understand how much profit is being generated on their products, right? And that is what a company wants to maximize. If somebody says, okay, gross profit margin is declining, that is a big warning sign, right? Because it's really hard to either raise your prices or decrease your cost of goods sold, right? It's just hard to do. So that is why gross profit margin is such an important ratio. Now we can move on to operating profit margin. So as we can see, the formula is just operating profit divided by revenue. So looking at our income statement, right? Well, that's basically gross profit minus operating expenses. That gets us down to operating income or operating profit. So this basically factors in everything that's considered normal course of business for the company. So looking at an example, well, it's very similar, except in this case, we need to add on that additional $150 of operating expenses. So that gets us down to operating profit of 100. So if we take operating profit of 100 divided into revenue of 500, that equals 0.2 or 20%. So again, for every single dollar of revenue the company generates, after factoring in operating expenses and cost of goods sold, they earn an operating profit on that $1 of 20 cents. So that is the easiest way to interpret it. And just like gross profit margin, investors want to see that operating profit margin increasing year over year. So as we continue to move down, we now are at net profit margin. This is basically net income or net profit divided by revenue. And net income, it obviously encompasses all revenue and expenses that the company incurs, regardless whether they're normal course of business or they're just not that common, right? So looking at our example, and it's coming directly from the income statement, we take that net income of $50 divided into revenue of 500, and that tells us that the net profit margin is 0.1 or 10%. So for every dollar of revenue, the company's only earning net income of 10 cents on the dollar. Just like the other ones, investors, they want to see a net profit margin that's at least stable, but hopefully increasing from the prior year to the current year. So one of the bonus ratios here is called EBITDA margin. And EBITDA is basically net income, but we add back interest expense, depreciation and amortization, as well as income taxes. And the idea is that, well, depreciation and amortization, it's not an actual cash expense, right? There is no cash outflow. And interest expense and income taxes, that is really company specific depending on their legal and organizational structure, right? So if we add that back, that basically tells us what the cash flow of the business is for just normal course of business and getting rid of whatever the capital and legal structure is. So while the formula for calculating EBITDA margin is simple, it's just EBITDA divided by revenue, it can sometimes be a little tricky as to how we arrive at EBITDA. More often than not, we're going to be given net income and we're going to have to calculate EBITDA. So let's get an example of that. So as the example says, well, Jazz Music had net income of $50. They had depreciation expense of $50. That depreciation expense would either be buried in cost of goods sold or operating expense, depending on what the type of asset was being depreciated. And then it says it has interest expense of $25 and then income taxes of $25. So on revenue of $500, what is the EBITDA margin? Well, two simple steps here. Starting with step one, that net income is our starting point. It's always going to be our starting point. That's $50. We're going to add back interest expense of $25. We're then going to add back depreciation expense of $50. And then we're also going to add back income taxes of $25. And that gets us to EBITDA of $150. So not super difficult, but you do need to remember all of the components of EBITDA. So then take EBITDA of $150, divide that into revenue of $500, and that tells us that our EBITDA margin is 0.3 or 30%. So for every dollar of revenue, we're earning EBITDA of 30 cents on that dollar. So I can almost promise you that you will see a question on one of these four margin ratios on the exam. So if you can remember the structure of an income statement and the why behind each of these ratios, because they are all used for different reasons, then it's going to make it much easier to take that information given in the question and solve the ratio or whatever the question's asking you to do. And lastly, make sure you know how to interpret these, right? If the margin were to increase or decrease, what does that actually mean for the business, and how can we use that to go ahead and make a decision to improve the value of the business in the long run? So one little topic here that I want to focus on real quick is called residual income. And the idea here is that a company, if they have many different divisions, they may say, okay, this division has this amount of invested capital or equity, and we want them to have a return of this amount, right? And so what we can do is say, okay, based on what the required return should have been versus the amount of income they actually generated, what is residual income? And that helps us determine where value is coming from if a company has different operating divisions. So as you can see in the formula, we'll start with net income and we'll subtract the required return times equity. And this is why I really want to focus on calling out the different terms you might see for each of these. So required return, it could say cost of equity, hurdle rate, weighted average cost of capital, or just even cost of capital. And then for equity, sometimes they'll say net book value or investment amount. Right? So make sure you understand the different variations of this formula. And guess what? When we get to the MCQs, we'll practice those different variations. So looking at an example for residual income, it says that jazz music had a division with equity of 200 and a required return of 10%. Now the division generated $30 of net income, so what is their residual income? So we've got the formula, but there's really two simple steps here. We'll always start with calculating the actual return. So we'll take that equity amount of 200, multiply by that required return of 10%, and that tells us the return in dollars was $20, right? That's what it was expected. And then we'll just take that net income of $30, subtract the required return in dollars of 20, and that means the division had residual income of $10. So they basically exceeded their required return. So if we're looking at whether that division was valuable or not, yes, because they generated income in excess of their required return. So now we're going to move into leverage. And there's really two types of leverage that we need to understand for the exam. That is operating leverage, and then there is financial leverage. So when we think about these two different types of leverages, they focus on different aspects, but basically they help us understand how a company can use leverage to either maximize or minimize their profits. So starting with operating leverage. So operating leverage, the formula is just fixed expenses divided by total expenses. And the idea here is that it helps us understand, okay, what level of revenue is needed to offset those fixed expenses? Because once those fixed expenses are offset, then perhaps every dollar of revenue goes straight to the bottom line, or at least a higher amount, right? So tricky concept. Let me show you an example. So moving away from jazz music for a bit, just because I'm tired of talking about jazz music, let's sit down for a burger at Bob's Burgers. And let's say that Bob's Burgers has both a sit-down and a drive-through. Now, obviously, the sit-down restaurant's going to have higher fixed expenses, but because there's more structure there, they can actually produce maybe burgers cheaper than the drive-through. Now, either way, it doesn't matter because what we're focused on is operating leverage. So if that is fixed expenses divided by total expenses, let's do the math. So for the sit-down, fixed expenses were 400, total expenses were 600. So that means 400 divided by 600, the operating leverage is 0.67. And then for the drive-through, we can see that yes, the fixed expenses are obviously lower at $100, right? Just having a drive-through versus a full sit-down, of course it costs less. But because of that, maybe Bob's Burgers is going to have a higher variable cost, right? So for every burger they sell, those variable expenses cost more. Now, his operating leverage for that drive-through is 0.4. So yes, it is lower than the sit-down restaurant. So it really comes back to what is Bob's risk appetite and how confident is he that he can offset those fixed costs. If he's like, well, I'm positive that I can offset those fixed costs, then he'll probably go with the sit-down restaurant because for every customer that comes in after offsetting those fixed costs, that profit is going to drop to the bottom line at a higher rate. For the drive-through, if he's like, well, I don't have a lot of confidence of being able to offset a high fixed cost base, so let's start with the drive-through. Yes, it's less risky, but for every customer will be less profitable, right? So that is how we can use operating leverage to assess what the right mix of variable versus fixed expenses are for a business and what that means for every dollar of revenues generated. How does that impact the ultimate profitability of a company? The other type of leverage is financial leverage. And the formula here is average total assets divided by average equity. And it basically tells us how much debt a company is using to finance its assets. So the higher this ratio, the higher amount of debt that is being used to finance assets. Now, there is no one good ratio here or bad. It just is a balance and something that we need to understand. So let's just do an example to see how the financial leverage ratio would be impacted if we were to issue debt for new equipment. So in this example, we're basically saying, okay, before we issue bonds to purchase $100 of equipment, well, if we have total assets of 500 and total equity of 200, that's financial leverage of 2.5. Now, if we issue those bonds for $100, it's going to impact our assets, right? Because we're getting that $100 of equipment. But guess what? Actual debt's not in this part of calculation. So we're only increasing the numerator here. That's going to increase our financial leverage. And basically the way to look at this is because the company has now used debt to finance assets, that is why their financial leverage ratio is higher. So if I'm asking you between two companies, which has more debt financing their assets, you would tell me whatever company has a higher financial leverage ratio, right? So that is how we can use that ratio to interpret a company's capital structure and how they are financing their assets. So now we're going to move into solvency ratios or debt ratios. And these are ratios used to assess a company's ability to meet its long-term debt obligations, right? Because if a company can't pay off its debt, it will default and we might have to liquidate the company. Because guess what? As a lender, if the company's not paying me back, I'm going to take its assets. I don't care if the company falls apart. So we're going to go through 4 different ratios. All of them are very, very similar, but they do have some differences, and we'll run through some examples as well. Starting with the total debt ratio, well, this ratio indicates the percentage of a company's assets that are provided through debt. So as you can imagine, the higher the ratio is, that means the higher amount of assets are financed with debt, and that can be risky. So the formula is total debt divided by total assets. If we look at an example here, it says that total debt for jazz music was a 175 on total assets of 350. Well, if we divide total debt of 175 into assets of 350, that equals 0.5 or 50%. That means 50% of jazz music's assets are financed with debt. So I can't tell you if that's super risky or not. We would have to compare that to maybe other companies in the industry, but that is how we interpret that ratio. Next up is debt to total capital. So the ratio here is total debt divided by total capital. And this just tells us the amount of debt that an organization has relative to its total capital. So the key thing here is to understand total capital. And that goes back to a little bit of the weighted average cost of capital formula. Remember, we would take any debt and any equity, we would add them together, and that's total capital. So as an example, if the company has total debt of 175 and then they have debt and equity of 175 each, that means capital is 350. So 175 divided by 350, that means the total debt to total capital ratio is 50%. So 50% of basically the company's capital is debt, right? So again, not sure if that's high or not. We just need to compare that to either what the company had in the past or peers in the industry. Next up is the debt to equity ratio. And gosh, that couldn't be more spot on with the actual formula. It's just total debt divided by total equity. And this basically tells us the amount of debt a company has relative to equity, right? You have your debt shareholders, you have your equity shareholders. Who has what claim on the company? So in our example, it says that total debt was 175, total equity was also 175. Divide those, you get 1.0 or 100%. Well, a ratio of 1.0 basically means that equity investors and creditors have an equal share on the company's assets. So that is how we can use that ratio to interpret who has what claim to what assets on the balance sheet for the company, right? So keep that in mind as you work through this. So when we think about the debt to equity ratio and the relationship between debt and risk, they have a direct relationship, right? The higher this ratio, the higher the total risk, because that basically means the higher the total amount of debt. And as we learned, debt is risky. So if we increase it, we're adding more and more risk, right? So that is how we can interpret the ratio. If it goes up, debt's been added and the risk also has increased for the company. The last solvency ratio is called the times interest earned ratio, often referred to as the TI ratio or the interest coverage ratio. And as you can see in the formula, it's just the earnings before interest and taxes. That's EBIT. Sometimes it could be operating income, and we divide that by interest expense. So let's look at an example and then really focus on how to interpret this ratio. So if EBIT is $75 and interest expense is $25, that means the times interest earned ratio is 3x. And that means they basically have 3 times as much earnings as they do interest expense. And from a lender's perspective, they want this ratio to be as high as possible, right? Because that indicates that they have an even better chance of actually paying that interest. Because guess what? If we're hovering around 1x, that means if there's a drop in profitability for the company, all of a sudden they can't pay off their interest payments, right? So that is a very important ratio. So let's dig into it just a bit more. So as you can see in the visual, the times interest earned ratio and risk, they have an inverse relationship because again, we want that ratio to be as high as possible. So if that ratio is going down, then risk is going up. If that ratio is going up, then guess what? Risk is going down, right? So if we think about it, inverse relationship between risk and the times interest earned ratio. So on the exam, it might ask you, okay, the times interest earned ratio last year was 5, now it's 10. Is the company increasing its risk or decreasing its risk? Well, guess what? The inverse relationship says that they're decreasing their risk. So make sure you know how to interpret this ratio. So we went through all 4 different types of solvency ratios. Again, these are heavily tested on the exam. Not only will you have to know how to calculate the ratios, but I can almost tell you if you see these in a simulation, they're going to be very focused on your ability to interpret the ratios and help make business decisions on what the company should do from an equity or debt perspective, right? So make sure you know those 4 ratios. So when a company takes out new debt or issues new debt, you can almost be certain that the lender or creditor will also issue debt covenants on that debt. And these are basically rules that the borrower must follow. So what happens if the borrower violates their debt covenants or doesn't follow the rules? Well, the lender may say, hey, you have to pay us back immediately, or we're going to modify the terms to be more favorable for us. So for a company, they better follow their debt covenants. And actually, in their annual 10K that they file with the SEC, the company must go through and make sure that they are in compliance with their debt covenants, and they have to state that in the financial statements. So it's very important because as an investor, you definitely want to know if a company's about to violate their debt covenants because that could cause the company to go bankrupt or liquidate completely, right? So very important. So a company has to follow their debt covenants, but what exactly do these covenants look like? Well, they'll basically include a ratio or metric and say you must be below or above this specific number for this ratio or metric. Otherwise, you're not going to be in compliance with your debt covenants. So let's take a look at what you could see. So as you can see in this example, it says the debt covenants for jazz music requires that they maintain a times interest earned ratio of at least 2x. And remember, when it comes to the times interest earned ratio, lenders, creditors, they want that ratio to be as high as possible because that gives a higher chance of them being repaid or that the company pays their interest expense. So basically this covenant's saying you have to have it at least at 2x. If it's more than 2x, you're compliant, but if it falls below 2x, you're not compliant, right? You're going to violate your debt covenants. So there are a lot of examples out there. We'll run through a few more when we go through multiple choice questions, but that is what a debt covenant is. So make sure you understand that at a high level, it's basically rules that a borrower must follow if they take on debt from a lender.